John, over the past several months, we've seen periods of high market volatility. Can you talk about some of the factors driving this, and what are the short and long-term market expectations?
Well, sure. I think some of the things we've been talking about, the growth scares that are out there, the perceived fragility, the fact that the U.S. seems to be the one source of robust economic growth going forward. I think those are all factors. Another one would be the first interest rate change in many, many years, and people trying to interpret what that means, how quickly the Fed is going to move on rates. And then, to some extent, I think there's always an element of feedback to this. Volatility tends to feed on itself sometimes, and so when there is a little bit of volatility, that gets amplified until it sort of stops. Volatility reflects uncertainty, and there is certainly a lot of uncertainty that's still out there in the marketplaces from a variety of sources.
Yeah, one of the things you mentioned, John, is the Fed hike in the lift in December, and there is a lot of uncertainty around turning points like those. I think what happened at the beginning of the year, the markets were really trying to understand not just that particular rate hike, but more the entire path of rate increases going forward and how basically the Fed is going to execute that, right? Perhaps as the months pass and there was more clarity in the Fed, basically in the message in terms of a pace, a very measured pace of rate hikes, that volatility has subsided on that front, right? And that volatility is also tied to what's happening in the oil markets and the currency markets with emerging market countries. So the Fed seems to be a little bit at the center of this. So
I think also there's a lasting imprint of the secular or strategic transformation, structural transformation in China. And so any policy changes there, because they're using a number of tools, as you, John and Roger, know. I think that in itself is also leading to a little bit more higher alert and sensitivity of the market to changes or devastating changes in policy, because a clearly differentiator versus 5 years ago is a world where China at best is growing 7, is probably growing closer to 5 versus the 10 or 12% growth rates. But you're right, John. Because the U.S. in many ways is like this oasis of growth, even if it's lower than historical average. That I think any number of those reasons why, even though volatility is low at this present time, we should be prepared for intermittent spikes.
The other thing I'd say too, Noni, is the volatility issue has just been one that has been on people's minds now for a longer period of time. You go back to 2008 and the global financial crisis, there's still echoes of that. So even in dealing with clients one-on-one, there's still a concern among individual clients and institutional clients about how to manage volatility in portfolios. And so anytime you see a little bit of a spike, and it happened back in the fall and then again now most recently at the beginning part of this year, you get that feedback loop going again. So, I guess I'd be prepared for another episode going forward. Nothing consistent about volatility other than it's volatile.